AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
I have you an opportunity to open the show this time, but you didn't.
But I'm the sidekick, so I'm not looking to improve my position.
You're content. All right.
Yeah.
This is the Real Estate Report radio show. It's call-in show, 800-516-1220, 800-516-1220. A busy week in real estate. Everybody's done with kids are back in school, and it's kind of been building up to this week. And we always get it right at the beginning of October, and the people want to close loans before November and December and the holidays, and it's very busy. And so are the markets. Of course, here in the Bay Area, they talk about how October and November are typically a good tech month. So there's a lot of tech people that are really excited that stocks are doing well, and their down payments are growing, and I think that's really one of the reasons why we're seeing a lot of people very active in purchasing homes. We're seeing a lot of offers getting accepted. I want to say all of ours, but a lot of offers getting accepted. Sellers are eager. This is a great time. It's the beginning of the season where you see more sellers a little bit more motivated to sell their homes so they can have quick transactions. You still have to follow the basics, a good offer, sometimes over asking price, sometimes no contingencies. But you're feeling the same thing, right, Gordon?
Yeah, I mean, fall's in high gear. Everywhere you look, leaves are falling off the trees. Halloween is around the corner, getting dark earlier, getting light later. So a lot of different things happen. And of course, this is a peak month for real estate sales. Typically, September, October are the best sales months of the year in real estate. What I'm seeing, as we talked last week, I'm seeing a lot more inventory coming to the marketplace. Every time I turn on my computer, I'm in all these chats and all these Realtor.com admissions. I get these messages, houses. A lot of units are becoming available on the marketplace, which is actually good. That's one of the things that we've been crying about is lacking inventory. So I'm seeing inventory pick up. We're seeing sales pick up. A lot of happy buyers. That's what we're seeing. A lot of our contracts that we're negotiating, talking to realtors and writing pre-approval letters are beginning to get approved. So it looks like we're going to close out 2017 in a robust fashion. And, it's good. It's good. I feel good.
CoreLogic's got some good news, as well as Realtor, the National Association of Realtors, and pretty much every index that you look at, they're looking at upbeat numbers. Yeah, the inventory's low. Yes, new home sales are low. Pending new home sales are low. Permits are all low, but there's still a lot of activity. So that's really good here going into this part of the season. Rates still great. That's one of the underlying factors in the motivation to buy a house is to lock in that low interest rate. Although we are going to talk about a story today coming up in this segment about the usage of adjustable rate mortgages, ARMs, and how they've picked up considerably over the last couple quarters. And we're going to talk about the reasons why. But meanwhile, the Freddie Mac Weekly Survey has 30-year fixed at 3.85%, and the 15-year at 3.15%, and the 5-year ARM at 3.18%. These are conforming rates that are sold to Fannie Mae and, in this case, Freddie Mac. But you get the general idea that these are conforming rates under $424,000. Anything higher, you could end up with a little bit slightly higher rate. But all of these rates are higher than last week. The culprit here, it's the stock market. Mortgage rates follow the 10-year bond yield. The 10-year yield follows the flow of money. When money is flowing out of the bonds, the yields are increased to attract more buyers. And when flowing in, the yields drop, so the mortgage rates drop. So generally, when you see the stock market doing well, like we're seeing right now, especially when it's reacting to news that indicates an improving economy, Gordon, you are going to see higher rates and the flow of money back into the stock market and away from bonds. And we saw a great example of that last year when Trump was elected. Rates increased dramatically, about 0.5%. There's a lot of promise of some great tax reform, and because investors like the talk of more friendly tax structures for corporations, when his plan fell short, we saw some rates drop throughout the year. In fact, we saw the lowest about 3 weeks ago. We saw rates the lowest they've been since right before he was elected, and then we were starting to see a little bit of resurgence in the markets and the enthusiasm towards this Trump, structure of taxes. And today we actually saw the Senate approve a pro lower tax plan, which benefits corporations, called the Budget Reconciliation, and that sparked the markets again.
Well,
and which is drawing money away from the bonds and this time though, it's being paired up with two other things. One, the Fed is decreasing their asset purchasing, and foreign demand for treasuries is falling off. Buying of foreign investors in treasury auctions has slipped, according to the chief international economist for Deutsche Bank, and so on. So we're seeing a combination of things that we could see a push in rates right now, Gordon.
well, you said a lot of things. So if you
I-
go
I-
back to
yeah.
if you go back to the main purpose, you said stock market is all time high. The Dow is up every time I turn on CNBC. It's at a record-setting pace. But one of the better things, even outside of the Dow, outside of the real estate market, outside of anything we can actually think of, one of the best things in the marketplace is consumer confidence. Americans feel good about this economy. America feels good about the stock market. Americans feel good about real estate. I mean, that goes a long way. How we feel is how we act. We spend more money. We invest. We do long-term planning, which is actually a very, very good stimulus for the marketplace that you really can't put your hand on as far as a number is concerned. But as far as a formula is concerned, it's very, very important to our economic environment. And that's what we're looking forward to that's going to carry over into 2018.
Phil Orlando, he's a chief strategist at the Federated Investors. He said, and this kind of sums up what's happening with this approval from the Senate today. Up until a week ago, there's been a lot of pessimism among investors that the Trump administration cannot pass any tax reforms. But that seemed to change last week when the Big Six, like the Senate, the House, and a few others, outlined their tax plan, and more people now believe companies' earnings will be boosted by lower tax rates. It's a victory for the Trump administration, for corporations. But whenever we see something like this, Gordon, we just talked about some of the other factors that push or move rates. Do you think this will fade away like some of the other things that we've seen throughout the year, where we've seen these huge ups and downs, 0.75% in rate differences?
Well, I always talk about everything works on stimulus, everything works on energy. I think right now, if you watch the Trump administration, what he's been talking about, his main push, his first push when he got into office was to remove Obamacare. He was unsuccessful in that. So it looks like even though they're still working on a plan, they've actually kind of backed away from that and moving there back into one of his things that he talked about, which was a tax cut. So as he pushes close to the end of the year, early 2018, I think that's where the focus of that administration is going to be on, is a tax cut. And everybody wants to pay lower taxes. We're already the highest tax nation, and I think the modern nations in the world. So our tax base rate needs to be cut to make us competitive in this economic environment that we're in the global economy, as we call it.
Well, we certainly see the markets reacting to this in a positive way. Unfortunately, that does mean higher rates, but in an economy that's improving, sometimes that's going to dictate higher rates. And that kind of brings us to the second story. By the way, you can call the show 800-516-1220, 800-516-1220. Email the show, info@bayarealoansource.com. I'm going to change that someday soon, so it's more like radio@bayarealoansource.com.
Okay, well, first you got to check and see if it's available.
It's our website.
Okay, then we can change it. Okay, then we can change it. We don't have to check for availability then. Okay.
All right. So ARM usage is rising. So you kind of go back and you talk about rates. And you talk about how interest rates are about 2% lower than the historical average. And then you talk about the theory of when rates are high, you get ARMs. When rates are low, you get fixed, the 30-year fixed. The number of adjustable rate mortgages or mortgage originations from the first to second quarter jumped 40% this year, according to the Mortgage Bankers Association. The difference between a 30-year fixed and a 5-year ARM, for example, is about 0.75%. So you can kind of see the incentive where people are going here. And we did start talking about this a couple of years ago, but rates never changed. The rates just kind of hovered around the 4% range, up and down, up and down, up and down. But it was the home prices now that we're seeing that are going up, 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 up. And now the 30-year fix isn't quite working for affordability for a lot of people. And now the result is they're going to the ARM because they do have that 0.75% difference. And that kind of translates into the high balance conforming loans and the jumbo loans and even in the portfolio loans. So you're seeing the lower interest rates helping people with affordability.
Well, typically, as we talked before, if anytime rates start to rise and there is an issue of affordability, a person is going to look for a lower payment. And how do you get a lower payment? Is with a lower rate. So if you're talking the spread between a 30-year fix and a 5-year fix is 3/4 of a point, depending on the dollar amount of the loan, that could be thousands, could be not thousands, hundreds of dollars that a person can actually save. So if you're mapping it out and say, look, you pay 3/4 of a rate less for 5 years or 60 months, in 60 months time you would have saved $65,000 in interest payments. People are going to go for that 5-year option, even though they don't have a plan after the 5-year option. Well, people are going to go for that lower payment, and that's what typically starts happening once you see that 30-year benchmark start to rise.
So what do you tell people when they're looking at an ARM and they really want a fixed? You have to give them an ARM to qualify, otherwise they have to put more money down, and they go, I don't have any more money down, and they start looking at how to qualify. We go back to 2005, leading up to the peaks that we saw in July of 2007. And ARM usage for purchases were 65 to 70% here in the Bay Area. Recently, that's been as low as 5%, and sometimes, and in some cases, lower. So we're going to start seeing that creep up. A lot of those ARMs, though, were neg-am loans. They were liar loans or stated income loans, but we don't have those anymore. We don't have the interest-only loans anymore that are on the conventional level. So or the qualified mortgage level. So without those two kinds of products in the mix, are you concerned at all that people might be going, okay, I'm going to get this ARM, I'm going to qualify now with it, but maybe 5 years down the road, I need to refinance because rates have gone up. Remember, you get the 30-year fixed when rates are low, and you get the ARMs when rates are high. So where are the rates going to go? They can only go up. And then maybe you can't qualify. Maybe your income stayed the same. You didn't pay a lot of, you paid your normal principal down. Value stayed the same. Are people risking not qualifying later, or do you think they just go, I'll get another ARM?
Yeah, actually,
or sell the house.
Actually, if you look at the mentality of the average consumer, very few people are interested in what's going to happen tomorrow. Most people are interested in what's going to happen today. So if today means, in order for me to qualify or get this property, they're going to go for an ARM, and that's what's available. They're going to take the ARM. If tomorrow they can't refinance or have an exit strategy that we always talk about, they're not going to be concerned about it, because the consensus is, I'll deal with that, Gordon, when it gets there. 5 years is a long time. On a schedule it is, but it really isn't. I believe 5 years is a very short period of time. But it turns out to be people make changes. Hopefully their employment income is going to increase, and they'll sell the property if they're banking on the depreciation. That's what they'll tell you. So, the mindset of a consumer, especially in today's world, real estate is a hot topic. Everybody wants to own property, and people will leverage themselves to the max to become a homeowner.
So when I got in the business, the person who trained me said, ARMs we're going to see rate fluctuations every 7 years. So we haven't seen that much in the last 7 years. So we may see that in the future. We may see that trend going back upward. So what the segment was really about is just kind of making people aware that, and we may come back and talk about this, ARMs do have that risk tied to, after that fixed period, it becomes adjustable to whatever the index is. So we'll come back after this break here on AM 1220 KDW. You can call the show 800-516-1220.
AM 1220 KDOW traffic.
This
is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're welcome to call the show 800-516-1220, 800-516-1220, or email the show Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com.
We love those emails.
So we kind of just, ARM usage is up. Adjustable rate mortgages, the general, consensus is when rates are low, you get the 30-year fix. When rates are high, you get the ARMs, because the ARMs, you can usually see a big difference in rate. In fact, when the rates are higher, the difference is even larger. And people are looking at these $1 million to $1.5 million homes. Shoot, you go to San Mateo County, and median home price is 1.1 or 1.2. It's hard to keep up with all of those numbers, but they've been moving so fast. You put 20% down, you're in a jumbo loan, and that's a huge number, and you can save 0.75% in rate, and that's going to add up to thousands and thousands of dollars a year, and then multiply that by 5 years. And right now, the 7-year ARM is really popular because it's pricing better than the 5 years. So I'm going to pay 7 years. That's going to buy me a lot of time. The risk.
One of the reasons why the 7-year arm is popular is because you qualify at the start rate with a 7-year arm. With a 5-year arm, you
have to
qualify
add
the
it
index plus
plus
the
2.
margin.
Yeah, plus 2.
That's one of the reasons why the 7 years is popular.
So the 7-year arm's popular. It does, any arm, of course, comes with risk. You're going to hear a lot of people, a lot of loan officers, hopefully, and I use that word loosely, hopefully you're going to hear a loan officer say, oh, when you get this arm, you have to make sure you understand what's going to happen in on the 85th payment. Your loan is going to adjust to the 1-year LIBOR or something like that, plus the margin, and your rate could go up as much as 5% on its first rate adjustment, or 2%. So you have to read the fine print when you get it. You don't just get caught up in that payment. We don't want to have that mentality we did back in 2007, where it was all about just what's my payment right now. I'm not worried about the future. So that's what an ARM is all about. But when you would want to use an ARM, almost 100% chance or 100% probability that an ARM works for you is, let's say you're going to sell your house in 5 or 6 years, get a 7-year ARM. Why would you have a 30-year fixed and pay more money to end up with the same balance, right? So there are some reasons why you would, in 100% of the time, use it, if you can predict that far in the future. But what do we tell these? What's the message that you want to tell people that's getting an ARM? Maybe the both sides. Yes, you can save some money, but watch out for what are the both sides?
Well, I always tell people, in a fixed rate environment in which we are now, in my professional opinion, I don't think it's worth the risk. You might say, yes, I'm going to sell my house in 5 years because in 5 years, my kids are going to be out of school and I'm going to be no longer have a need for this house. In 5 years, you might be a foster parent or a grandparent and find that you don't want to sell that house and you want to stay in it. So our life changes. We're in constant change mode because the circumstance, situation changes. So a lot of times when we make plans that are etched in stone and then we have to modify those plans, it can lead to some turbulence. That's why we always say, that's why the exit strategy is so important. Hey, listen, I've got X amount of money saved. If I have to bring in money to buy the loan down in order to make the payment, if the payment goes up,
that's a really good point. For when I had a car many years ago and I paid it off and I made a mistake, and I was told one time, it says if you ever pay off your car, continue making that payment to yourself. So have a bank account, pay $300 or whatever your car payment was to that bank account. So you kind of keep that habit. And I didn't. And then when I went buy a new car, my car broke down. I finally had to buy a new car. I had to get a new payment. I was like, payment shock again. But if I would have kept making that payment, I would have had that, or saved that money. I would have had the money for a down payment, or I would have been used to making that payment, or changed my income or whatever. People who get an ARM, I think it's extremely important that you go, okay, here's the 30-year fixed, what I could get. Here's what I'm going to get. The difference in payment is $280 a month. I'm going to put that $280 a month and I'm going to put it over here. It's going to earn some interest. I'm not going to touch it. I'm going to keep that habit as though I'm paying a 30-year fixed. And if worst case happens in 7 years and rates are up and you can't refinance, you have something to work with to help buy that rate down, or put it in the principal balance to help out, or something. I would not recommend getting a 7-year any ARM if you can only qualify for that payment and you're not able to save some money. That would be my opinion. All right, because there's always an ARM that you can get down at the end of the road.
Yeah, it's important to budget. It's important to plan. That's the value of that. And we always talk. There's a lot of tools on the web that can help you forecast where that thing is going to be. You can actually go back in history. So if I'm selling a 7-year ARM today, I can say, well, if you did a 7-year ARM 7 years ago, and today October 1st was your 85th payment, based on the index and the margin stipulated inside the note, this is what your rate would go to, and this is what the payment would be. So there's no more secrets or any unknown factors. It's pretty much spelled out. You just have to be able to follow the terms of the note and get someone to really explain to you what you're doing, what the feature and the benefit of that cost and that index is, and that margin and what that actually is. That's going to tell you what your true rate is when that ARM finally does adjust into another 5-year fix or a 25-year fix.
I like the strategy of actually getting an ARM, but making the 30-year fixed payment, and then at the end of that 5-year or 7-year ARM, your actual balance is much, 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 much lower. It's kind of accelerating it. And that's another kind of strategy. Anyways, you can call the show 800-516-1220 or email us, Tony@BayAreaLoanSource.com. We'll come right back.
This is Money 2.0 on AM 1220 KDOW.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for listening to the show. We hopefully you're your best second opinion on real estate and helping you make wise decisions, not to rush into any products or any real estate transactions that you think are not to your best interest. I mean, that's what we do every day.
But we get a lot of emails from people that have said, "Hey, listen, I love your sound advice. It's given me something to think about. I've become a better consumer when it comes to real estate, when it comes to loans, when it comes to rents, and my children now are moving to the rental market, and as they become, it's just kind of really good that we talk about many different topics. There's just one on here in the Bay Area, so I mean, we do feel we're providing a great service.
You can always email the show, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. We did get an email from Reed in San Francisco. He's retired, but he kept his consulting job up and running. I didn't record any income in 2015, but did well in 2016. Even though I didn't record income in 2015, am I still considered a 2-year plus employee? Because you need 2 years as self-employed.
So any income outside your traditional income, in order for us to give you credit, we need a 2-year history of that income.
Right. Self-employed's, gosh, I hate saying this word. It's still getting the shaft. That's what stated income was for. It worked. They're also getting a shaft because they don't use net income gross income, where a W-2 employee uses gross income. But they come down to net, and you have a lot of write-offs. Write-offs like, it could be household expenses, and you're using, and these write-offs take right off your income. So they keep hitting you and keep hitting you, but we're still going to follow the guidelines. And in this case, if you were to start a business in 2016, self-employed, or moved from W-2 to a self-employed and stayed in the same business, you won't qualify. You still need 2 years, okay? Unless you go to some sort of portfolio product where you just got to put more money down and accept the higher rate. But in his case, because he actually had the business for longer than 2 years, but he just didn't record any income in 2015, he still, and we did talk to Reed. He did actually file a Schedule C with his business name on it with a big 0 right at top. So now in this case, he didn't record it, so they still average the income over 2 years. So in this case, let's say if you make $50,000 in 2016, but only 0 in 2015, that's $25,000 a year, or roughly $2,000 a month. So yes, the income's going to be lower, but we'll be able to use it. So retired, he probably has either a pension or Social Security or both, and maybe has some spousal income or other income like that. But because he filed that schedule, that's a smart move. I wonder if somebody actually told him to do that.
I mean, sounds like he's got proper advice, and that's why we always tell you, before you do something, check with a professional. It's always good to talk to somebody. So like people call us and says, "Hey, listen, I got a lady call me this week. She has a daycare center. She filed in 2016, and she said she wrote off just about everything." She said she grossed almost $308,000 with the state employed kids, but she netted about $40,000. And she said she wants to buy a house. She realized she can't buy anything. She's going to have to wait till 2017 and be able to average that income. She says she'll claim a lot less expenses this year because now she understands the magnitude of how it's going to affect
all those write-offs,
becoming a homeowner. A lot of times people just write stuff off to write stuff off. We see people sometimes getting bad tax advice, just writing off businesses that just to show a loss, just in order to pay less taxes, but they end up shooting themselves in the foot when it comes to a loan. Yeah,
so we are going to be getting up close to tax time. It seems like it's always there. Oh, there's tax time right now.
Tax time is year planning. It's year-round planning.
Yeah, we're coming right up on the deadline. We just had a client that goes, I didn't file my 2016 taxes, and I'm about to file that. I got the extension. I paid the taxes, but I need to. I'm like, okay, if you wait after this date, the lender's going to actually ask you for these returns. So, and they have to be verified with the IRS. So and she's putting an offer in, right? She wants her offer accepted. So those are some of the things you want to ask, or at least disclose to your loan officer prior to, I didn't do it and I'm putting offers in. So we are getting closer to tax time. We will talk more and more. We have a great CPA that we bring on occasion. And we want to start getting people to think about what they're doing with their taxes, especially if they're looking at a transaction. We love the people who have multiple real estate properties, and those are the kind of people that we really need to talk about.
Advice.
We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That's Gordon Hines.
AM 1220 KDOW traffic.
This report is brought to you by PETA. We're still looking at some very heavy traffic on the Nimitz Freeway.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. You can always call the show, 800-516-1220, 800-516-1220. A little bit of news out there. Optimism on personal finance drops again, fourth time in 5 weeks, and the sharpest decline since 2016 September. This all follows a 16-year high that we saw in August. The weakness was driven by a sudden drop in optimism about personal finances, much to do with the higher gas prices after certain hurricanes hit. Do you follow any of these kind of stats, Gordon?
I mean, those stats change weekly, monthly, it looks like. It all depends on what the market's doing, what the economy's doing. Those things always tend to change. So you just got to make sure. We always tell people you got to qualify and quantify that information you can actually read in, because that's just someone else's opinion as far as I'm concerned.
Other news out there, Lennar Homes. This is a really interesting story. They found a creative way to help millennials with student debt to help them buy homes, unveiling a new program that offers to pay off your student loan or up to a certain amount when you buy one of their new homes. For example, instead of getting upgraded floors or upgraded kitchens or bathrooms, they're going to pay off your debt instead. What do you think of that?
Wow, that's creative.
Opponents to this program say nothing is for free. It's the reason, and this is the reason why I don't like this program. And they're rolling the debt either into the mortgage or they're jacking your, I don't like using that word, but they're increasing your rate, jacking it up. All with the intent to help them qualify for, to lower their debt ratio. And they're also they could be pushing up the price of the house and throwing back the money to the buyer. And in a private transaction, we know that's illegal. Yet if they disclose it, they're able to do it. So there's a founder and president of what they call the Society for Financial Education and Professional Development, Ted Daniels. He warns new buyers saying, make sure you understand your transaction and pull back your emotions and be sure you know where the dollars are going. It works. There might be a precedent set here, and where you have to wonder how far it'll go. But increasing sales prices to kind of kick back and pay off debt, that'd be a really interesting way that, we know that right now, if you have debt, you can use some of your down payment to pay off some debt. For example, we're doing one right now where a woman has a $396 car payment, but she only owes $4,000. So she's just taking $4,000 out of her down payment and paying that off, and that helps her debt ratio. Those things make sense, but we're not getting a kickback from the seller.
Well, it's creative finance, and once again, if you follow the market, as things start to go up, the market has to get more creative to sustain its current condition. So that's creative finance. And if a guy comes to buy a house and listen, he's got $15,000 consumer debt, the builder says, okay, listen, what we can do is we can roll that $15,000 into the price of your home, and we're going to have you pay off that home. Then now you can qualify. It's creative finance, and those are things that are always going to happen.
So you're all aboard on something like that.
As long as it makes economic sense. I mean,
and
it's got to make economic sense. The problem is, of course, is after the guy buys the house and he goes out and charge back up another $15,000 back to square one, and that's the only thing you have to do. But you can't really legislate, I always call it legislate consumer behavior, because people do things for different reasons at different times.
I'm not sure if this is related, but Lennar's third quarter profits are up 5.6%.
Okay, well, the bottom line, all these public companies
they're doing something that works.
Have to adhere and give pleasure to the shareholders, right? Another great story and that's tightly related is Facebook. Facebook and Apple, these Microsoft, these guys have exuberance and large stash of cash. Facebook is doing two big things. There's a big project here in the city of San Francisco in which Facebook is spending $35 million on a property that they don't own, in which they're moving to help renovate this high-rise building. The bottom floor is going to be for almost like off-site job training, and the top floor is going to be the units for their employees. The same thing they're doing in Virginia. They're spending $1 billion on this data center.
Where are they doing that? Where are they doing that in Virginia?
And right outside of I didn't write.
Say Richmond. I got a house in
Richmond. It's the Commonwealth. The Commonwealth. I just said the Commonwealth, which is Virginia. It didn't say the exact city, but they're investing $1 billion into this new data center.
It sounds like Amazon all over right now. Amazon right now is waiting to pick a city in the United States. Did you hear the mayor of San Jose?
I heard the mayor of San Jose this morning saying that he's not going to offer them a tax cut.
He doesn't want to throw it on the backs of the taxpayers.
Yeah.
And there's going to be a city out there, and what's interesting is you're looking at 50,000 employees with $100,000 average or median income being thrown into a city. it's going to change the city. It's going to turn a second-tier city into a top-tier city, or third into top tier. It does. That's a lot of money. That's a lot of housing that's needed, a lot of infrastructure.
Well, that's the same concept that the professional teams, when they want stadiums. You know, Oakland didn't want to spend for a stadium for the Raiders, so they went to Las Vegas to find money for a stadium for the team. So it's the same type of thing. You got to figure out, what do you leverage, what do you get, and how does the city benefit in the long run? That's what you got to look at.
I love those stories. I'm gonna definitely keep an eye on Amazon. And what they're doing, and I'm gonna look into that Google thing.
Well, New York, I mean, some of the big cities
where they're building that.
If you go back to that Amazon story, a lot of the big players, when I say big players, I mean big states. New York is courting them grossly to come in. They said they already have the infrastructure, the public transportation. They already got the qualified workers there in New York. Michigan is courting them to come in. Texas is courting them to come in. California, of course. So wherever it land, it's going to bring high-paying jobs. That's one thing it does bring. Home prices are going to go through the roof, and that's always the consequence.
You can always call the show 800-516-1220, 800-516-1220. You can email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. This is another short little tidbit story. I kind of pay attention to these things, and it's kind of the nerd in me. Lot sizes for new homes are the smallest since the Census Bureau started following this stat in 1992, when home lots were 10,000 square feet. What do you think they are today on average?
Probably 4,000.
No, 8,562.
Wow.
So,
well, if you kind of think about it,
but
if
but another stat though, real quick,
lot size, they can get one more house out of it. That's another $500,000.
Another tidbit on that, and it's a story I read a while back. Home sizes are increasing, so our lots are getting smaller, and our home sizes are getting bigger. Home appreciation is back to 7% according to CoreLogic's, and that's year over year, of course. Home price index, the increase came after about 3 years. Where it hovered around 5%. CoreLogic showed that Las Vegas, that is, with the highest year-over-year appreciation in Denver in second. And we saw those reports from the National Association of Realtors showing double-digit year-over-year. And an interesting comment by Frank Nothaff, chief economist at CoreLogic. While growth in home sales has stalled due to a lack of inventory during the last few months, tight inventory has actually helped stabilize price growth. I'm not sure if I agree with that. But they also predict 4.7% year over year to next August. So good news for people buying houses. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. That is Gordon Hines. You can always go to our website, BayAreaLoanSource.com, for more information.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us. Call the show 800-516-1220. If you're shy, you can always email us, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Gordon is our resident professional investor. I'd like to say you've been in the business 25 years plus. You own several properties, many properties. You manage properties, and you've owned your business for 20 plus years.
Yeah, it just seemed to make me seem so old when you start 25 years.
You can go see his picture. Yeah. It's before he dyed his hair.
Well, to this day in history, believe it or not, 2011, we're always talking about monies and stuff. Steve Jobs died today. And Steve Jobs where would Apple be without Steve Jobs? And look where Apple has been. And also 1947, Harry Truman, the first televised presidential address to the nation was done today in 1947. Boy, what a day a year makes. Is that great or good or bad?
It's good. Yeah. We learn from history. That's what my history teacher said. I took my course twice because I like my history teacher so much. Well, there's a thing we should talk about.
Fannie Mae recently had made some changes to their format again in the DU approval. The PIWs are back again.
PIWs, yes. That's called a property inspection waiver. And that means that if you have a good scenario and you have what they call a standardized address, more appraisals are going to be waived. We just had one done today on a purchase, which I've never seen before. So it's really kicking in right away. DU stands for desktop underwriting. It's the automated approval decision that you have to go through to use a Fannie Mae or Freddie Mac product. And that's really good news to hear. Anything else from Fannie Mae?
Well, what that means is finally these big companies are beginning to use technology. We have all this database. So basically, estimating the value of a house is not rocket science. So they have these things built into their formula. So when you plug in a value and you plug in a purchase price, the system recognizes the value of that property, and hey, they give you a PIW, which is the waiver. That means you don't have to do an appraisal. It's a $6 or $7 savings. It can save time on closings. Now we can close your loans in 10 days instead of 15.
So there are going to be some cases where it won't work. Cash out transactions, you're going to need appraisal in most cases, and credit score. It's basically your whole scenario. So they weigh it just like they weigh your approval. But it's good news to hear that's coming out. Another story out there, millennials still interested in buying houses. About 80% say they plan to buy a house or condo in the near future, but their time frame has been extended. According to the report by Apartment List, which they are known for a very interesting stat that came out, and they identified how long this was a really interesting stat. They identified how long it takes for a millennial to save for a 20% down payment in all of the cities in the United States, including San Jose, Los Angeles, and so on. They said they're the ones who said that San Jose, if you lived in San Jose, you're a millennial. 23.9 years to save your down payment. Anyways.
So that means that no millennials are going to be buying houses, if that's the case.
Not for 20. Anyways, unless they get married. That's very interesting. But according to the report, 36% of respondents said they would wait over 5 years to buy. This is up 23%. I'm sorry, up from 23% in 2014. The top reasons say affordability. They're not ready to settle down, and they're waiting for marriage. Marriage is key. Dual incomes make a big difference, and you qualify. There are a lot of jumbo low down payment products, so qualifying is also the key here. Affordability, 53% that down payment was their biggest obstacle, with 68% saying they've saved less than $1,000 and 44% saying they've saved nothing at all. Really interesting stats on the millennials, the biggest buyer pool out there, and yet 80% still say they want to buy. We are here to help. We always recommend you start early with the transaction. Start with your credit. We have, look at your student loans. Look at the low down payment products. We get creative with first and second loans if we have to. We help people not take things off, but work with credit agencies on fixing credit. So there's a lot of things you can do in advance, and I don't feel intimidated if you are looking to buy a house. Just start early and work with professionals. I'm Tony Mendez. That's Gordon Hines.
We'll be back next week. Thank you for tuning in.
Yep. You can always go to our website, BayAreaLoanSource.com, or you send us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Thanks for being with us.